He made his name calling out companies he believed were overvalued, dishonest, or headed for collapse. To some people, Andrew Leff was a Wall Street watchdog. To others, he was one of the most feared short sellers in America. But in June of 2026, a federal jury in Los Angeles decided something much darker. Prosecutors said Leff was not just exposing the market, they said he was moving it. And while ordinary investors reacted to his public warnings, he was already positioned to profit. This is the story of how a famous fraud hunter became the center of a fraud case himself. And the question at the center of it is bigger than one trader. When does a public market opinion become manipulation? Andrew Leff built his reputation through Citron Research. His model was simple on the surface. Find a public company, publish a sharp report or public statement, argue the stock was overpriced, broken, suspicious, or heading lower, then watch the market react. That kind of work is not automatically illegal. Short sellers can play an important role in markets. They can expose weak companies, inflated claims, bad accounting, and even real fraud. But prosecutors said Leff crossed the line. They argued that his public persona gave him power. When he posted, people listened. When he went on television, investors reacted. When he issued a price target, the stock could move. And according to the government, he knew that. Here's the core of the government's case. Before making a public statement about a stock, Leff would allegedly take a position that could profit from the market reaction. Sometimes that meant betting a stock would fall. Sometimes it meant taking a bullish position. But the key was timing. Prosecutors said he would make a public recommendation, cause a short-term move, then quickly exit the trade. The public saw one message. The private trading told a different story. DOJ said Leff used online posts, public reports, and media appearances to create market-moving events. Then before those statements went public, he allegedly placed trades designed to profit from the reaction. In some cases, prosecutors said he entered limit orders in the opposite direction of what he was publicly recommending. That means while the public heard one signal, his trading strategy was already prepared for the exit. That is the part that gives the story its edge. It was not just about being negative on a company. It was about whether the public message was being used as bait. The most important detail is not just that Leff traded. It is how fast prosecutors said he moved. According to the government, he used his control over timing. He knew when his report would drop. He knew when his tweet would go live. He knew when the public would see his commentary. So prosecutors said he built positions before the market reaction, then closed them after the price moved. They also said he used short-dated options contracts. That matters because short-dated options can magnify quick price moves. They can expire the same day or within days. So if someone can influence a stock's short-term movement, even a small move can become a major profit opportunity. That was the government's theory. The influence was the engine. Timing was the lever. The options were the accelerator. And ordinary investors were the ones reacting after the machine was already in motion. This is where the story becomes powerful. Leff's public image depended on credibility. People had to believe his research was independent. They had to believe his warnings were honest. They had to believe that when he said a stock was going lower or higher, he meant it. But prosecutors argued that his public recommendations were not always aligned with his private behavior. That gap became the case. Public confidence on one side, private profit on the other. And for retail investors, that gap can be brutal. Because by the time they saw the post, watched the TV segment, or reacted to the report, the person who moved the market may have already been preparing to leave the trade. The case did not turn on whether short selling is legal. Short selling is legal. Publishing negative research is legal. Being wrong about a company is not automatically a crime. The case turned on intent, timing, and alleged deception. Prosecutors focused on the pattern: public statements, market reaction, fast private trades, profits, again and again. They argued this was not normal commentary. It was a short and distort scheme. A public megaphone was allegedly being used to create price movement, while the private trading account captured the upside. In June of 2026, the jury convicted Leff of one count of participating in a securities fraud scheme and 12 counts of securities fraud. The government said the scheme generated more than $21 million in profits, but the story did not end with the conviction. After the verdict, Leff's defense team reportedly demanded a mistrial. Their argument centered on a courtroom mistake. They said the jury used an outdated verdict form that included a count the judge had already dismissed. That gives the ending a live wire feeling. Leff is convicted. Sentencing is scheduled, but the defense is still fighting. If the mistrial argument succeeds, prosecutors may have to try the case again. If it fails, the conviction becomes part of a larger warning to Wall Street influencers, activist short sellers, and anyone whose online comments can move markets. This case scares people on both sides. Some say the verdict protects retail investors from powerful voices who can move markets and quietly profit behind the scenes. Others say it could chill activist short selling, which has historically exposed real fraud and corporate misconduct. That is what makes the story bigger than Andrew Leff, because modern markets are not just moved by earnings reports anymore. They're moved by tweets, podcasts, YouTube clips, cable news hits, Substack posts, Discord rumors, and personalities with large followings. So the real question is this: if someone can move a stock with their words, how honest do they have to be about what they're doing with their money? Andrew Leff became famous by accusing companies of misleading the public. Then prosecutors accused him of misleading the public. That is the twist. The fraud hunter became the fraud defendant, and now his case may define a new era of market influence. Because in today's market, the most powerful trade might not start on a trading screen. It might start with a post, a headline, a TV hit, or one trusted voice telling everyone else where the money is going next. So now the real question is simple. Was Andrew Left a fraud hunter who crossed the line, or was this a warning to anyone powerful enough to move a stock with one post? Tell me what you think in the comments. And if you want more stories about fraud, power, money, and the people who thought they were too smart to get caught, hit like, subscribe, and turn on notifications, because this is only the beginning.